So it's interesting that Carol said we're gonna talk about VCs. We're actually not gonna talk about VCs. We're very intentionally not going to talk about VCs. We're gonna backtrack from the world of venture capital. And I know we've done a lot of discussion about the progression from an independent brand through a VC raise to that sort of strategic exit that we all seem to think we should all be having. But I believe very strongly, and we all do, that we'd be doing you a big disservice if we didn't talk through some other ways of funding growth that can match your company aims. In fact, some of the people who run those funds have started thinking about those things differently themselves. And it's because not everyone wants to sell, and not everyone wants to run a company, and not every investor is really intent on getting a brand into the portfolio of a strategic. So we're going to talk with some investors from outside the VC world to hear how they work and how they look at businesses, and maybe help folks understand how you might want to think about alternative routes to your own futures. So to do this, I'm going to invite on stage Douglas Raggio of Bias and Blind Spots and Michael Silverman of Samantha Brands Group. And we're going to sit down, we're going to talk about this for a little bit. He's got the pole position. So from the pole position, let's just really quickly talk about who you are and what your investment model is and why an entrepreneur in this group might find it beneficial. So we'll start from the pole.
Yeah, we founded Samantha Brands Group about 2.5 years ago, and it was born of our observations around the industry that there are a lot of up-and-coming CPG brands that might go demonstrate a proof of concept, proof of consumer following, and get that early distribution, but oftentimes lack access to resources, operational resources, back office, distribution, and really understanding how to sort of play the game in terms of bricks and mortar grocery expansion. And so we set out to build a centralized team and say, we want to go identify brands that work really well with our framework and think about a rigorous analytical platform driven by data where we can go identify brands, plug it in, and partner with entrepreneurs that are awesome creative talents, but might benefit from the infrastructure we're creating.
So give an example or talk about some of the brands that are in there and what you do with them specifically.
So I'll give you an example of Trace Latin Foods. So that was a brand we found a couple years ago. And essentially when we found it, it was called Trace Pupusas. It's making, pupusas are Salvadorian in descent, corn masa pucks with different fillings in them. And we said, that's not a pupusa company, that's a Latin foods platform. And so we continued to evolve it in that direction, trying to understand the category dynamics and leveraging data to say, where does it make sense to go keep expanding? And how can we keep telling this story of incrementality to our retail partners? Because that's what we're always going to focus on. So we leveraged that initial kind of consumer magic around the pupusas resonating, and we took it into mini pupusas, tamales, sauces, salsas, and we continue to build a premium mainstream Latin brand there.
Now, I want to talk about where the role of the founder exists within this framework.
Yeah, so we're super flexible there. It comes down to what the founder wants. So give you two different examples. We've got a company called Veggie Goes, where the founder is still the CEO, but he just exists inside of our framework, and we're having operational meetings every week together. He owns his P&L, but we come up with those things together. We analyze data together, and he's really the steward of the authenticity around his brand. But we put together that infrastructure around him to help him out. Trace Latin Foods is an example where the founder is still involved, but just focused less full time on a product development front, and we'll do sort of everything in between there.
And so you've bought a majority stake or a complete ownership stake in these companies?
Yeah, it's a controlling stake. So we don't necessarily need an economic majority, but the idea is that we want to be able to leverage the infrastructure that we've built.
And what do you see as being the advantage for the founder? Because it's they're giving up control. Right?
Yeah. It's certainly not the right approach for everybody. I think that a lot of times creative founders are very product centric, and CPG and especially scaling in bricks and mortar grocery can be a very inefficient business model that oftentimes can be obfuscated from newcomers. And so we'd like to think that we have a playbook, not the playbook, in terms of being able to kind of light the way and be able to leverage our retail relationships and our understanding of manufacturing and our back office capabilities to really be able to navigate those things, understand what to go spend against, and how to go drive that trial and repeat curve.
All right, Doug, we're going to catch you up from a lap behind. Tell us about bias and blind spots.
Sure. So I've been in this industry as an investor, as a founder, as an investment manager on both buy and sell side, a fund manager, a strategic buyer, a strategic seller. Gotten an education along the way, and bias and blind spots is really my attempt to have some of those awkward conversations that people aren't talking about and bring them out into the light. Things such as, where do all these exits materialize? How many big buyers are there to put up the big checks that the funds demand or will need? Where do they all go? What happened to earnings? Just conversations like that I think are a bit overweight with all the VC exit-driven hype that the media promotes, that they're sexy and big. But there are some fundamental flaws if we want to have a healthy ecosystem of businesses in our space. It can't just be all VC cash. So I work with very large family offices that have limitless amounts of cash. They're inherently risk averse. They don't like risk, and you can't show them hockey stick growth, tons of marketing spend, no assets, and you're going to sell because these 5 outliers sold. That's not a very compelling pitch for a family office. So I work with a lot of family offices when they want to identify an early stage investment is to how to build in assets and how to take out some of the risk, looking for moderate returns over time.
So explain it in terms of an operator model. What are they getting from you, and what are they doing?
For a founder, they're getting a long-term partner. Most of the wealth in America was created by having a business that had profits for a long period of time. Okay. Yes, there's of course the tech side of things, but fundamentally, a long-living business with profits that moderately grow over time is a way to accumulate generational wealth. So, from a founder's perspective, when you have a family office that's coming into the table, they're really looking 5 generations down the line. Somebody in that family tree's made a ton of cash, and it's every generation's role to extend that capital as far as possible. So if you want a long-term business, you're partnering with a family that has long-term interest as well. It's part of their charter, their investment, their family office, the chief investment officer. So you asked me this question earlier, and I had a venture capital fund 10 years ago before it was sexy called Gastronome Ventures. And I found myself putting undue pressure on founders for some very short-sighted aims of my own and our investors. It wasn't really aligned with the mission of the founders, but I was looking for the pump to exit, and it felt like, pardon my French, I felt like shit. And I realized that a win for us and my investors was taking a good food company and selling it to a lesser quality food company, and then I was contributing to further consolidation in our space. And 7 to 11 companies can't own all of food, especially when they're publicly traded and they have quarterly earnings to make. Like, food compromises start to get made. So how do I work with the people that want to reinvest in the supply chain? And we have a lot of founders in our space that idolize the Chobanis and the Patagonias of the world, but they don't take that path of hard work, long-term, slow growth. Chobani maybe was not really slow growth, but you got to make those longer-term decisions. If you want to reinvest in your supply chain, the statement I make is you can't solve long-term problems with short-term cash. So if that's the kind of business you want, you need capital that has some longevity and some generations behind it. And that's really what I'm trying to solve with bias and blind spots.
So how does the funding model work?
It's incredibly flexible because family offices do everything and nothing all at once. So I was talking with somebody earlier during this event, but we function like a merchant bank. We use kind of a debt equity hybrid. So we give people a line of equity that's accessed when needed and returned when you can, and kind of our equity is based off what our commitment size is and what's returned over time. So in the equity line model, founders dilute investors. Again, our investors aren't looking for the $100 million exit in a year. They have plenty of money. They're looking for long-term moderate gains over time. So if you think of it like a film, Tom Cruise, like him or don't, but he'll take a smaller fee up front for a larger into the box office. And that's the proposition I'm asking founders is give us a lower risk investment up front, and you can have the bigger box office because your distributions over time get larger as ours get lower and lower. So it's a fundamental difference of thinking. It kind of flips the venture model on its head. And it's difficult to get a lot of the service providers to understand it. That's most of our time. We were talking yesterday about, the attorneys and the accountants don't quite understand anything other than a convertible note and an equity priced round.
Yeah.
It's tough.
Yeah, and it's also because you're dealing with companies that aren't existing to flip, right? They're existing to build sort of generational products and
we like assets. We like building equipment and buildings out and trucks. Like that's something that protects. This is the other thing is, if you're taking money from a family office, you got to always look at the downside. Like, does the money go to zero? Do they lose their entire investment? Or did you buy a bunch of equipment and trucks and infrastructure that if a worst case scenario happened, could it be sold off and scrapped out? And could they save some money? Or not save some money, but retain some of their investment. So, it's all about the risk return assumptions of your investor. If it's venture, it's kind of a shorter window with a higher return. That's why they have a portfolio. Their 1 in 100 will hit and they'll be fine with it. What happens to the 99 others is what concerns me about our food system. But then you look at the other side, which is family offices. They want low returns over a long period of time. So I'm an asset-heavy infrastructure building guy. Reinvest in the supply chain. We have an 18-year window on most of our models. Now it's not going to hit, but that's how far we look ahead, just on our own internal modeling.
So what I think is interesting for because these are very divergent funding models. What I think is interesting is it requires different, or it allows for different types of founder CEOs. Some may say, I'm not great at running a business. Some may say, I want to build a business. Do you find that these are outliers in the entrepreneurial community and that most of the folks should be thinking build and flip? Or is it just that there's too much hype around that kind of sexy exit?
You want to go first?
Sure. I think what's so important is to understand what you want going into it, right? And then I think that really informs the kind of play that you want to go run. There's a great discussion yesterday about planning for sort of recessionary periods. And so if you take a really aggressive fix and flip approach and you run into a point in time where access to capital dries up, it's not going to be a great scenario. If you have a partner that is essentially standing in your shoes with you, that can change that dynamic a little bit. And so that's the way we think about it. I don't think that, in my opinion, not everybody who's entering into starting a new CPG brand should be thinking, I got to go fix and flip this. I think you have to take an opportunistic approach where, at some point the price is right, you should definitely go do that. But if you say, I'm for sure coming into this, I'm going to sell this in 5 years, I think that's going to be a pretty tough road, and you're going to be challenged between access to capital and operational challenges and what have you. So to say that everybody should be doing that, I think is tough. But certainly, if you can take advantage of that, go for it.
So we do know there does seem to be opportunity to get these massive sales done, at least more opportunity than in the past. But I think what Doug's saying is even if it's, 100 times more than it was in the past. We've still gone to 1 in 100 companies, 1 in 1,000.
Well, to your question on founders is I hear more often than not when I talk to a founder about what kind of our philosophy is, and it's, I didn't know you existed, and I just told you what I thought you wanted to hear. So there's a lot of founders that are coached to put on presentations that have hockey stick growth, more heavy marketing spend, asset light, and it's a narrative out there. And so, it's kind of a light bulb moment when I finally can get a founder to think, wow, like there's a different way to build my company. And if you look at just the numbers, it's pretty general knowledge that 1 in 100 VCs across categories, 1 in 100 investments hits, and that covers the whole nut for the most part. Now, our internal math puts the number of investments in food and beverage in the last 3 years at 5,000. So if 1 in 5,000 or 1 in 105,000 wins, we're talking about 50 exits in the next 2 years. That's 2 big deals announced every month for 2 years straight. It's kind of unreasonable. So that's not going to happen. And even if that did happen, what happens to the 4,950? From an investor standpoint, I would write it off. That sucks for a founder. So, it's one thing to play the lottery and go for the big jackpot and spend $1 or $2 on a scratcher. It's another thing to like leverage your house, put your kids' college educations on the line, work your ass off to have it be put in somebody else's like chess game to be scrapped later because something else in the portfolio was going. It's that sacrifice the many for the few mentality. And that's, for me, it really bothers me.
So I want to add that you two aren't the only games in town either. So what are some other alternative, we heard about RSF social finance today, for example, and people who are willing to lend to cause-based companies, and just people who are willing to lend, as that is a
fine.
Yeah, as that is a model that's opened up. That's a line of financing that's opened up a lot more, and we have a lot of lenders here. I wanted to see what other models out there, what other types of financing can enable our founders here to think a little longer term and allow them the opportunity to make a few mistakes as they go forward.
Yeah, I mean, there's a couple of great organizations that are here at this event, but I've seen more venture debt players. I think what's interesting is there's no one that's really taken pole position on being the SVB for CPG, but if you understand the operational metrics and how a brand is performing, and to Doug's point, there's oftentimes solid assets on the balance sheet. I think these can be really interesting businesses to lend to at a venture stage, even if they're not necessarily cash flowing. So there seem to be more players doing that. I think there's a lot of opportunity for brands to look around and say, hey, who's complementary to me, is maybe selling to the same tribe, we can have synergistic sort of category stories together, and does it make sense to put things together? And so, I know there's some folks in Colorado that are sort of putting things together and doing similar kind of approaches to that. Anything where you can go either access capital or imitate scale. I think there's increasingly a lot of unique and innovative ways to do that, and I think it's incumbent upon the entrepreneur to think about that.
I like the phrase, imitate scale.
Yeah.
My response to that would be, it's about expectations. So you're going to get a higher valuation, probably a quicker close, with more founder favorable terms for the most part from a venture capital group, because they are spraying and praying. If you were to knock down your valuation to something that's rational, you could attract all kinds of other patient capital. So there's nothing wrong with equity investing. It's kind of just the expectations that are put around kind of this VC hype, is that we're going to invest and we're going to be $1 billion company and sell in 5 years, or a $100 million company and sell in 5 years. Whereas in reality, it's kind of, you can take your valuation and say, here, I have a partner for life who has endless amounts of cash, cheaper cost of capital, probably has assets and equipment and warehouses you could use in many situations because they have real estate. And yes, I'm going to have to take a smaller valuation, but that's not sexy to people. So my whole thing is, if there's plenty of cash out there, it's just where's your expectations on returns, what's the expectation on the growth of your business, and being reasonable. If you're going to look for a partner for life, they're not going to pump and dump you. So that's just, the minute you drop your valuation, give some coverage to the downside, all kinds of cash frees up. Because nobody says no to a less risky investment, is usually what I found.
How does that change the way that you operate the company itself?
We were just talking about that. I don't know, because right now we have all these companies that have been funded by venture and private equity, and they have, aggressive growth, a lot of door counts increasing, but they're discounting heavy to get the velocity. That's track A, is what somebody told me this morning, and the track B is like profitable moderate growth. I don't know how you take something off track A and put it on track B without a lot of headcount cuts and a lot of dialing back of your retail doors and pulling manufacturing in-house, which is costly. And then if your costs are lower, you can't go up in price with your customer. You can really only go down. So I don't, from an operations standpoint of what we're seeing right now with kind of all this VC and cash coming in and these inflated valuations and these high growth companies without profits, I don't know how they adjust. So from an operations standpoint, I'm a big proponent from day one of a strong balance sheet. That means you have to raise more money to start with a stronger balance sheet, but you have to identify every opportunity. You can't just say we're going to get on every store in every region and we're going to move product fast as we're doing BOGOs or whatever other tricks you can manufacture to move product, because that's not sustainable. When the tap turns off of all that cash that's been funding that to date, you're left with nothing. It's really, I don't know what happens after that. I think we're all going to find out in short order.
Well, that's quite a trickle of cold water.
Sorry. The awkward conversations, man.
And that's why we have them because we're in the business of giving entrepreneurs opportunities to succeed, and maybe as we heard from Nicole, rethink what success means a little bit. I know that that having expressed dissatisfaction with these traditional methods, I wonder if there are other changes coming to the industry overall that might make what you're doing more or less relevant. One thing that I think about is the localization of food shopping and sort of consumers moving into more co-op type products, as well as D2C, which can be less capital intensive. Are there other things that might, I guess, make it less of a binary choice between VC or alt VC?
You mentioned about the literacy of the consumer. That story to source is very important. I think it's going to continue to gather importance and become more relevant to the customer. And with that being said, it's hard to build a company that touches your source if you're using all contracted out labor, contracted sourcing. You're arm's distance away from that stuff. And so if you want to pull a sustainable, a regenerative supply chain story for your customer, then you have to put the resources behind it. And that kind of goes back to that long-term problem, short-term cash. As a fund manager, I would not have invested in a supply chain that wouldn't see a return in 10 years because I need to see a return in 5. Didn't make sense. That wasn't my model.
Because you're responsible not just to yourself.
There's people with much larger wallets that are breathing down your neck every day to get that return. Not fun. So, no longer doing that.
Yeah, I mean, I think to Doug's point, you have to, I think you see a lot of entrepreneurs and management teams that are super passionate about their products, and rightly so, but if you can really figure out how to go listen to what the marketplace is telling you, not just the consumer, but the marketplace at large, investors, retailers, and really understand that it's your retailer that's your partner quite often in getting to the consumer, and thinking about how can I be the best partner possible, and how can I be leveraging my brand to create the products that are going to really help my category manager, have my consumer enjoy them, and maybe aren't the things that I'm personally really passionate about today, but still might fit into my brand and might be a more opportunistic way of scaling. I think that's something that I see a lot, where if you get a retailer to go underwrite a new product launch that you've kind of collaborated on together, it's an incredible way to go launch something instead of saying, oh, we'll build it and they will come. Yeah. And we just have to have the new thing that we're going to go sell in. And is it incremental? I don't know. Is it delicious? Maybe. Is it coolly branded? Yeah, maybe. But is it something that category managers are going to be super excited about and that we're going to get the buy-in on? I think that's just being flexible and really listening to the marketplace universe is telling you about what you're doing.
So let's talk, because I want everyone to understand this is actually about opportunity to run a great business and to build wealth, as Doug was saying, through a long-term company that generates profit. So I want to ask, what kind of companies are you looking for right now? What are the food companies you guys want to meet and finance?
So we're really looking at kind of the same companies that private equity would be looking at. We're just selling a different end game. Whereas private equity is selling we'll build you and we'll sell you. That's how they get the returns. We're saying we'll build you and you keep it. So I didn't really ever think that I'd be competing with that kind of caliber of an investor. But that's really what we're looking at. Things that have strong balance sheets, things that have some assets, or are willing to put that into play. So yeah, the narrative in the story in our scenario ends, because again, it's a different outcome. So by selling a different outcome, we can compete head to head with kind of traditional private equity in the B, C, D rounds.
Are you better for a vertically integrated business, do you think?
Do I prefer?
Is that a better model for your investment?
I don't know better. It depends on how it's been built, right? Again, we look at the balance sheet, we look at kind of what the downside is, and that's if every meeting I have with one of our families is, if this goes to zero, how do we save our shirt? So depending on how that vertical integration's been built, yes, no, I don't know. That's probably a case-by-case basis. But don't be afraid of building a business that has assets and has some moderate gains. You don't have to show hockey stick growth, because again, a private patient investor isn't looking for the 1 in 100 home runs. He knows that's not real. He or she. They're looking for the moderate gains slowly over time, and that's what will extend their generational wealth to 5 more generations down the line. So, anyway.
And you, Mike?
Yeah, we're ultimately it comes down to really wanting to find a brand and series of products that can be a platform. Hopefully exist across multiple categories eventually, but really look for that story of incrementality that we can tell. Where is it either a unique occasion or are we going to be able to go into the retailer and explain to them through data and through our analysis why we're going to go help you build your category together, and here's how, and here's the demographic that we're going to be pulling in, and really be able to understand who's the tribe for this brand that we're communicating to, and how can we be the best partners possible for all the mechanisms that are ultimately getting the product to the consumer. That and we worry a little bit around supply chain stuff. So we're in frozen, but I think we'd shy away from fresh and other things where there's just higher instances of shrink or shelf life issues. All right,
gentlemen, thank you very much. That's incredible food for thought.
Yeah, pleasure. Thanks for having us.